What a smart recovery by the Nifty above 25,600. It's a good morning and a great time to talk about India's strategy from the lens of the Managing Director, Head of Research and Strategist at CLSA India, Vikash Kumar. Vikash, great to speak with you. And we enjoy these chats because we look forward to dissecting notes that come from your house and on various sectors as well. You seem to have a nuanced view on earnings this quarter. Let's start from there, where optically it definitely is an improvement, but when you sift through what's happening sector by sector, you see that maybe it's a bit lopsided in terms of growth.
That's right, even sector by sector as well as by market cap. From a top-down perspective, it was not a bad quarter. We actually saw revenue growth pick up to double-digit levels at after a long time. But profit growth was all right at 9%, but that was the lowest we've seen in 5 quarters. But more importantly, that came from largely 2 areas: oil and gas and financials. If you strip those off, those 2 areas off, then profit growth was just about 0.6% YOY, which was far lower than a number closer to 20% that we saw last quarter. So clearly, it's lopsided. Even the action that we saw when we look at NSE 500, and here we are talking of consensus numbers only, small caps is one area which continued to see downgrade of 3 to 4% in terms of estimates for FY27 and FY28, which will actually not show up if you just look at NSE 500, where estimates were higher, and that upgrade was largely led by large caps, where there was upgrade of a little less than 1%. So there is lopsidedness even in terms of sectors as well as the market capitalization of these stocks.
Within this bucket, though, what would you say stands out as a shift? There is a lot of bullishness around financials, and I'm just going to take this Q3 conversation a little further. There's a lot of bullishness around financials. Are you seeing that as well?
Yeah, so that's something which is not hidden. It's also in performance. Financials as well as materials and metals is the place where we metals particularly, where we've seen upgrades as well. So that's the one area in terms of sectors where there is still more preference for that sector. However, on the small cap side, what stands out if we look at consensus numbers broken into market capitalization is small caps expectations are, sky high will be actually not a perfect definition. I would say even more than that. Expectation is that they would grow earnings at over 28% EPS CAGR. That's a 2-year growth. That's something which I think appears quite vulnerable to me. That small cap as a basket, 250 names.
Hi Vikash, good morning. So I just want to delve a little deeper into that to say that obviously that 28% looks a little crazy at this point, and so therefore you've already seen EPS cuts. You're saying that further EPS cuts are possible, and what pockets are you anticipating in the small cap space, even if they're not necessarily as defined as you would look at with regard to the large caps and the mid caps?
Yeah, so morning, Alex. So a few things over there, 2 things mainly. Firstly is if we look at the distribution of that earnings estimate, and that's the first thing that we look at, because sometimes these could be influenced by just a few names. That's not the case. So percentage of that small cap basket, that is the 250 names, which are expected to grow earnings by over 20%. Over a 2-year CAGR of 20%, that's 62% of the small cap names. And just for some kind of reality check in terms of actual delivery, what we see is the percentage of small caps which have delivered a 20% EPS CAGR over the trailing 4 quarters is less than 40%. So the gap is pretty big over there. Also, imagining a 28% kind of earnings CAGR at a time when nominal GDP growth is expected to be sub 10%, that's the estimate of our house, appears quite optimistic to us.
Understood. Speaking of a few sectors, and I'm also quoting your report, you're talking about real estate, healthcare, industrials, which have seen a bulk of the downgrades. Specifically on healthcare and looking at hospitals perhaps, they're all undertaking significant capacity addition. So is that what is posing the major problem in the near term at least? And does that turn around materially once this capacity is added? Because there is expected to be a fundamental requirement for medical care even going forward.
Yeah, so healthcare would be a combination of pharma and hospitals. On hospitals, what you said would be possibly true, that if there is a little bit of a delay here and there, then that earning shifts from one year to the other one. So that's something which is quite possible. Yes, they are going through, a few of the big ones are seeing significant capacity additions. And that can typically be a trigger once you get a hang of when these capacities are actually going to come in.
Okay, Vikash, good morning. Hira on this side. Now, when you're talking about the valuation aspect of India as well, the valuation premium post 2025 is a key that everyone has been watching out for. Somewhere, we're looking slightly more attractive than what we were in calendar year 2025. Absolute valuations still very high. Do you see any re-rating aspect on this front now if you have to look at this calendar year?
Yeah, hi, Hiral. So I think if we look at January, that has been the worst relative performance month for India as a market versus EM or Asia X in this century, barring just 1 month. So only 1 month has India underperformed more than what it underperformed in January 2026. That month was May 2004, when BJP had lost election and we saw 2 circuits on the market on the election results day. That was a big event. If you take that out, then we've seen the worst month of performance where we underperformed by nearly 13 to 14 percentage points in January. But to my surprise, we haven't really, from a PE perspective, corrected as much for the simple reason that our EM peers have seen reasonable earnings upgrades led by Korea, Taiwan, Brazil. So what has happened is that although they have done much better than us, their PE hasn't really gone up because a lot of that performance has been on the back of earnings upgrades. So that is why after that kind of dramatic underperformance, we should have gone back to our longer term 20-year average premium. We are still more than 10 percentage points away from there. So that's the surprising thing. What we need to appreciate is while India is underperforming, a lot of the performance in other markets is also driven by earnings upgrades, which has so far escaped us.
Okay, now that's an interesting point that you make. And the other one, I'm going to come back to the first part of the conversation where you've said that 80% of your Q3 earnings have come in just because of oil and gas and the financials as a sector. Now, if this is the concentration that we are seeing, are you seeing any systemic risk in the broader markets, number one? And two, another heavyweight sector, which is IT, underperforming. Are you seeing any chances of re-rating on that aspect?
Sure. So now the IT bit is less to do with earnings because they haven't really seen large earning downgrades even in this particular quarter. It is more to do with narrative. And so that's less to do with earnings. What I said, just to clarify, is 80% of the incremental profit growth is contributed by 2 sectors. So it's not that earnings are 80% are contributed from there. So I think it can also be a case of one particular quarter. So I would not really draw that as an example to extrapolate for the coming quarters. This was also the case with the kind of margins that some of the oil marketing companies saw for this quarter. So I would leave that as one particular quarter's observation and nothing beyond that in terms of extrapolating. So that's where we are on that question.
No, so just to drill down on IT, not in the context of earnings, they're facing a bigger threat than just earnings. And there seems to be a view that by some that they will survive, and Indian IT companies and the fear about their survival is overblown. Is that something you agree with?
Yeah, so if you just take a step back and look at what's happening globally, so we had in 2025 there was a lot of trade where hyperscalers and the the LLM linked AI trade was playing out. Then sometime towards the late 2025 period, we moved to the point where there was some kind of uncertainty whether LLM linked AI trade is the best way to play it. Then we went into the pick and shovel trade, which is where if you are part of the supply chain of AI, whether you are kind of energy part of supply chain, the commodity part of supply chain, or at the same point of time, the chip and the memory part of supply chain, then that's the bit that you would like to play. So if you look at the large EM markets, Brazil offers the commodity part of supply chain. Korea and Taiwan offers the memory and the chip part of supply chain. What does India offer? India offer the services part of supply chain. Now the debate right now is whether AI could be very close to something that organizations can implement on their own without a lot of help from service providers. That's the kind of narrative that is going on right now. If that is the narrative, then what India offers is not the most attractive part of the AI supply chain. And that's the part which could be disrupted the most. Our personal opinion is that that's not the case. I think global enterprise will need services uh, industry to kind of help them navigate this big structural change in technology. However, the market is uncertain on that. Now, till there are events to challenge that narrative, I think it is difficult to fight a narrative like that. All that we can say is that if you look at recent commentary from IT companies, recent guidance numbers which have come out, even the NASSCOM guidance which has come out, all of them appear to suggest that 26 will be a better year in terms of growth than 25. But in the midst of the current narrative, that's not something that the market wants to focus on.
Yeah, or the market is finding credible till they see evidence of it, perhaps. Thank you so much, Vikash, for speaking with us today. It's always a pleasure to have you on. That was the CLSA voice on markets and on IT.